Agenda for today is a double entry system, and what are the learning outcomes? We are going to define the accounting equation. We are going to explain the components of accounting equation, understand the concept of assets, liabilities, and the owner's interest, sometimes called the owner's equity, sometimes called capital, or sometimes it is referred as the residual interest. All right, let us discuss the accounting equation. We discussed previously components of your financial statements. Statement of financial position is one of the components we discussed earlier. What we report on statement of financial position are assets, liabilities, and equity, sometimes called the owner's capital or owner's equity, or owner interest, residual interest in the business. So this is how it looks like. Assets minus liabilities is equal to owner's interest. This is called the basic accounting equation. This is the fundamental accounting equation. It shows you that what a business owns, assets, less what the business owes, liabilities. Assets less liabilities is what you call the ownership interest or equity. So this ownership interest is also referred to as shareholders' equity or stockholders' equity or just equity or capital. Many alternative terms are used. So what basically this is, ownership interest, also called residual claim. It means that if once all creditors' liabilities have been paid, the remaining assets, whatever is left, belongs to the owners or shareholders or proprietors or partners for that matter. So these points are foundational for understanding how financial statements are constructed and how they reflect the financial status of a business. So there are many alternative ways of expressing the accounting equation. What we saw here, assets minus liabilities is equal to ownership interest. So we can rewrite it as assets is equal to liabilities plus owner interest or owner equity. That's what is done here. Assets is equal to liabilities plus ownership interest. Or you can make ownership interest as the subject. You can just work around the equation and make whatever you want to make out of it. Okay, so let us discuss the first two components, assets and liabilities. When we say assets, these are the resources available to the business, owned or controlled. So these are the resources owned or controlled by the business, and these resources are expected to bring future economic benefits. Land, building, machinery, vehicles, computer equipment, fixture fitting, so on and so forth. These are the tangible assets. Tangible assets are what you can touch, buildings, machinery. And there are also intangible assets like patents, trademarks, the assets that do not have physical existence. So then liabilities, they represent obligations of the business. They are what the business owes to others. Liabilities include loans, accounts payable, mortgages, any amount we have received from our customers in advance, also called deferred revenues, or any other such obligations that need to be paid in the future. So understanding these two, assets and liabilities, it is very crucial because they form the building blocks of balance sheet, helping to assess the financial health and operational capacity of a business. Assets, resources, owned and controlled by the business, they are needed for the business to operate and grow. A business that has sizable assets, it has more potential to grow, while liabilities represent the funding that must be repaid, right? And these fundings, they impact your cash flows and of course your financial stability. So next we have, how do we measure assets and liabilities? First we have historical cost. Historical cost, basically this is the amount originally paid to acquire an asset, or the amount agreed upon when you acquired an asset, when the transaction first occurred. So basically historical cost remain unchanged in accounting records, no matter what the market value of the assets are. So these costs remain the same regardless of changes in the market value. So it provides a clear record of the actual cost of assets or liabilities. So this would ensure consistency, because the amount we paid or agreed to pay is verifiable. So this ensures consistency and comparability in financial statements. The next alternative we have is fair value. So basically, fair value reflects the current market conditions and can fluctuate over time. So this measurement is more relevant in dynamic markets, as it provides a more accurate depiction of assets or liabilities' current value. So fair value is the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So these two methods, historical cost and fair value, they serve different purposes and are used based on the relevance and reliability of information they provide. So historical cost is praised for its reliability and simplicity. It's verifiable. Whereas the fair value, it offers greater relevance because it is more current. It is suitable for more dynamic environments. But the problem is that it can introduce volatility and complexity in the financial reporting, because fair value keeps on changing, whereas historical cost stays the same. So it ensures consistency, comparability, but it may be outdated. Fair value is good. It reflects the current price, but the price is volatile. So these two alternatives are available, and both are allowed under IFRS, International Financial Reporting Standard. But in the US GAAP, Generally Accepted Accounting Principle, we use historical cost only for non-current assets. Assets cannot be revalued or cannot be reported in fair value. These are the different accounting regimes for now. So under IFRS, that is the more prevalent accounting regime across the world. Both measurements are allowed. Okay, let us define an asset. An asset represents economic resource controlled by the entity as a result of past events. Let us break this down. First, a present economic resource. An asset represents a resource that is currently available and under the control of an entity, meaning the business or organization has the right to use this resource. Second component, controlled by the entity. It means business has obtained control over the resource through some transaction or maybe some past event. For example, you may have purchased equipment or acquired a patent. And then the last part is this asset or economic resource is capable of producing economic benefits. Means this asset is expected to provide future benefits to the business. And this might be through generating income, or this might be through reducing expenses by using efficient assets, or by providing some other form of value. So in simple words, an asset is anything valuable that a business owns, controls, which is expected to provide the future benefits based on some past transactions, based on some past decisions or some past events. So this is the analysis we have just discussed. Let us see some examples of assets. Land and building owned by the business, raw materials owned by the business which would be used to produce goods. Like for example, if I am in shoemaking business, the sheets of leather, they represent raw material, and through production process I convert those sheets of leather into finished goods like shoe, bags, leather belts. So raw material is also an asset. Cash held in bank account is also an asset. Amounts due from customers with a promise to pay. We have sold goods on credit to our customers, so any amount due from them also represents an asset. And investments in shares in other companies. Yes, you may have surplus cash at bank. So in order to make more money out of the money, so instead of putting your money in a checking account or called the current account in UK, we can make use of this cash? We can invest in shares of other companies, we can buy bonds of some other companies, we can invest in property. So investment in shares, bonds, or other valuable items, they are also an asset. So when do we recognize an item as an asset? First, when it meets the definition of an asset. Means a resource must qualify as an asset. Means it is controlled by the business and expected to bring future economic benefits. For example, a company buys a machine that will be used to produce goods for sale. So it must qualify as an asset. Then the resulting information is relevant and gives faithful representation. What does it mean? The information about the asset should be relevant to the decision of users of financial statements and must accurately reflect the economic reality. For example, recognizing a building at its purchase price, like we purchase a building for $1 million, it provides a clear and accurate cost figure for investors assessing the company's assets base. So this original historical cost is the amount which we can faithfully and accurately put on the balance sheet. The next component, cost of providing information do not exceed benefit. That is an important point to be understood. The benefit gained from information about the asset should outweigh the cost of gathering and presenting it. For example, it may not be worth extensively appraising a low value piece of office equipment because the cost of appraisal could exceed the asset's benefit. Okay, let us consider reporting a low value asset. Let's say we have a small office printer. The cost of the printer is $100, let's say. The estimated life of this printer is 5 years, let's say. And which means this $100 will be consumed in 5 years, which means the annual reduction in the value, which you call depreciation in accounting. The annual depreciation is $100 by 5. That means $20 is depreciated every year. Okay, now let us say we want to incur some cost to appraise and report the printer. Appraisal cost is $50, let's say. And the annual reporting cost is $10 per year for 5 years, so that's $50. So the total cost of appraisal and reporting, 50 plus 50, $100. Okay, now let us see now the total cost of purchasing this printer plus cost of appraisal plus cost of reporting gives you a total figure of $200. Now consider this printer should provide us some benefit since it does not generate any revenue. Assume this printer saves us $30 per year. So for 5 years it will save $150. Now look at this. This is the total cost to purchase, appraise, and report, and this is the benefit generated. This is the cost on your right side, left side shows you the benefits. So what you see, it may not be worth the effort and resources to perform a detailed reporting and appraisal just beyond the basic purchase. So just go for the basic purchase. Do not appraise, do not report. Just $100 versus $150 makes sense. This is the cost, this is the benefit, fine. But when the reporting cost, the appraisal cost is added, it's $200, which is clearly more than the benefit expected. So these efforts do not add significant value in the understanding the company's financial position or decision making. So that's the basic idea conveyed in this line, that your cost of providing information do not exceed benefits. Okay, let us apply it to a more relevant example. Land and buildings, raw material, these are the two assets. Should we recognize them? These are tangible assets, especially this one has long useful life. So they typically appreciate over time, land and building. or they will generate stable rental income for you if you may have put these properties on rent. So they provide you relatively certain future economic benefits. So that's why we need to recognize them, because they provide you certainty about the future benefits. So why recognize raw material? Why? Raw materials are essential inputs in the production process. Like if I'm into leather business, so leather is my input, leather sheets are my input. They are converted into shoes, finished goods, which are sold to generate revenue. So this direct link to production and sales provides a clear evidence that the raw material has the capacity to generate future economic benefits. So we are going to recognize both of them. Now let us discuss some other resources controlled by the business which we do not recognize. Workforce. Competent, capable workforce can generate economic benefit. Yes, they do. Advertisement campaign also generates benefits. So let us discuss, if we do not recognize, why we don't. No doubt skilled workforce is crucial for business operation. It does not meet the definition of an asset for recognition on the balance sheet. Why? Because an entity does not control its workforce in the same way it controls physical assets. Employees can choose to leave, and their potential to generate future benefits can go somewhere else. And moreover, their potential future benefit they can generate cannot be independently verified or reliably measured in financial terms. So that's why we don't. Why not advertisement campaign? Advertising costs are typically expensed as incurred. We don't recognize them as an asset. Although advertising can increase future sales, the direct financial benefit are uncertain. We are not sure if you spend $100 on advertisement, how much will it increase our sales? There is no definitive evidence that a specific amount spent will result in increase in future cash flows. So, for this reason, we do not recognize them as an asset. Why? Because there is uncertainty of benefits, lack of evidence that cash flows will flow to the business in the future. So this differentiation helps maintain clarity in financial reporting. How? We are only reporting those items with a relatively certain future economic benefit about which we are relatively certain. Hence, they are recorded as an asset, thereby providing a more reliable and relevant information to the users of financial statements. So that's the criteria. Moving on. Okay, now the second component of the accounting equation, defining a liability. Okay, so what is a liability? It's a present obligation of the entity to transfer an economic resource as a result of past events. Let us break this down and try to make some sense out of it. Let us start off with an example. A company borrows $50,000 from a bank to finance a new equipment, let's say. So this is the loan amount. All right. So let us break down the liability components we just discussed in the previous definition. First, past event. The company signs a loan agreement with the bank and receives $50,000. This is the event, past event, which has resulted in a form of obligation which you need to settle. So signing of loan agreement is the past event. Second component, present obligation. Please excuse me for these squiggles. So as per the loan agreement, the company is legally required to repay the loan. And third, transfer of economic resources. So the repayment will include both the principal amount, $50,000, and the interest. So this is it. This is the liability. So liability can now be fully understood that it's a present obligation to transfer economic resources as a result of past event. As simple as that. So let's say what it says here. Present obligation, legal or as a result of commercial reality. We have to repay the loan. Transfer economic resources. So when we will settle this obligation, it will result in outflow of $50,000 cash plus interest on the loan. And this liability has resulted from a past event, which basically was signing off the loan contract with the bank. So this is how you can understand the concept of a liability. Recognition of liability, it follows the same idea. Liability meets the definition. Resulting information is relevant and provides faithful representation, same as it was for recognition for asset. And cost of providing information do not exceed the benefit. Just look at recognition of assets and you can apply the same idea here in recognition of liability as well. Bank borrowing by the business is an example of liability. Sales tax payable by the business, liability. Accounts payable, from whom we have purchased goods or services, and credit. Accrued expenses means the expenses that have been incurred but not yet paid. Bonds payable, money received from our customers against which no goods or services have yet been provided, liability. Leases, mortgage payables, warranty liabilities, employee benefit payables, customer deposits, dividends payable, and the list is endless. Liabilities that are not recognized. Let me give you an example. Okay, look at this gentleman. He has got injured while working, and he has filed a case in the court of law against the company that he has been injured just because he was not provided proper safety gears. And this injury is caused by the company's faulty safety and security measures. So he has claimed a compensation of $10 million. He may win the case against the company or he may lose. So since we are not sure whether the firm will have to pay this amount as compensation, because the liability, this liability is dependent upon a contingency, dependent upon the decision by the court. So what do we do in this case? Since it may become a liability, but it is not a liability right now, so what should we do? We can't show it as a liability on the balance sheet, but since the amount is significant and it is, let's say, it is probable that the future event like the court decision may go against us. In this case, we report it on the books of account as a liability. And if it is not probable, it is reasonably possible. These are from accounting standards, just get the idea. Then we just show it in the notes to account. So if it is probable that the case is surely going to go against us, in that case we report it as a liability. But if it is reasonably possible, mean chances of occurrence are less than probable, then we just report this event with the detail in the notes to accounts. So this case, an item that fails the recognition test, not reported in the balance sheet, might well be reported in the notes to accounts as a contingent liability. This case against the firm may become a liability, but it is contingent, it is dependent upon the court decision. So we just report it in the notes. But if our lawyer tells us that it is probable, occurrence is more than 80% probable, that means we need to book it as a liability. Otherwise, it is reported just in the notes to accounts, right? So because it is the accounting concept prudence that tells us that if there is any likely loss, we need to bring it in our accounting records. Okay, now here we come to the last part of the accounting equations. We have discussed assets, we have discussed liabilities, and assets less liabilities is what you call the owner's equity or ownership interest or the residual interest, right? So the ownership interest, also called the residual interest or the equity, is the residual amount found by deducting all the entities' liabilities here from all the entities' assets. So assets less liabilities, all assets less all liabilities gives you equity. This is also called residual interest. Sometimes it is also called net assets. Total assets less liabilities. Sometimes it is also called net assets. So the question is, what would be the figure for equity? It is totally dependent upon the recognition of assets and the recognition of liabilities. Their net will give you the ownership interest or the residual interest, or equity, or sometimes called net assets. Okay, now we have this accounting equation, assets minus liabilities is equal to equity. This equation is always in equilibrium. Right hand side will be equal to left hand side at any point in time. At any point in time. Let us say, let's take some imaginary numbers. We have 100,000 worth of assets and $30,000 total liabilities, and our equity clearly is $70,000. All right. Let's say, consider we have purchased goods on credit. We have purchased goods worth $10,000 on credit. What will happen? These goods will add on to our assets. Now assets now want $10,000. Since we have purchased these goods on credit, it's a liability. So our liabilities increase by 10,000. So a new figure is $40,000. The net figure still stays the same. Both sides are in equilibrium. Let's take another example. We sold some goods which had a cost of $3,000, and we sold these goods for $5,000 cash. Please follow. Cost of the goods $3,000, sold for $5,000 in cash. So when we receive $5,000 cash, our assets go up by $5,000. Fine. But at the same time, goods which are the cost of $3,000, they are leaving the business. So goods leave, $3,000 reduction. Cash comes in, $5,000 addition. So there is a total addition of $3,000 to the left hand side in assets. So we have 112. Liabilities do not change. Since this 2,000 represents income, gain, this gain belongs to whom? To the owner. So the equity increases to $72,000. Absolutely in the state of equilibrium. Let's do another transaction. We withdrew $7,000 from bank to acquire a piece of machinery. What happens? Assets decrease by 7,000. Bank decreases. At the same time, a piece of machinery comes in the business. So the total amount stays the same. Liabilities stay the same. Equity stays the same. Okay, let's say owner has a car which he doesn't use. He brings the car in the business to be used for the business purposes, and the value of the car, let's say, is $8,000. Resultantly, our assets go up to $120,000. No change in liability. Since this is the additional investment by the owner, his equity, his right on the business, his claim on the business increases by this amount, and that's going to be $80,000. Still, the equation is in perfect harmony. All right, let us discuss another example. Let's say there is a fire and goods worth $20,000 have been burnt, and these goods were not insured. It's a loss. $20,000 worth of goods gone. Balance of assets $100,000. Liabilities stay the same. Since this loss is the loss that goes directly to the owner's equity, so the owner equity also decreases by $60,000. So whatever happens, any accounting transaction of any nature, your accounting equation would always be in equilibrium. The right hand side and left hand side would always be the same. Okay, let's take another example. The owner takes away a computer for his son's use. The value of the computer was $3,000. So he has taken away the computer to his home. Resultantly, our assets fall to $97,000. Liabilities stay the same. Since he is withdrawing an asset for his personal use, just like this addition of vehicle added on to his equity, any withdrawal in the form of cash, any piece of asset, any goods that he trades in, is reduced from equity. So equity would now be $57,000. Revenue and expenses. We have discussed assets, liabilities, and the residual interest or the ownership interest. Let us talk about the business activity now. Business is engaged in selling goods and services. So what you receive by selling goods and services is called revenue. So revenue is an increase in ownership interest. Whenever a business earns revenue, it would result in increase in net assets or increase in ownership interest. So when a business sells product or when a business sells a service, the customer makes the payment or the customer promises to pay. For example, a software company that sells a new software license for $500, this $500 is recorded as a revenue. So what is revenue? It is increase in ownership interest. Any revenue increases ownership interest. Any expense decreases ownership interest. Any benefit in the business increases ownership interest. Any loss decreases the ownership interest. This is the basic idea you need to remember. So when you provide a service or a good to a customer, the payment is made or a promise of payment is made. This is called revenue. So what are expenses? Simply an expense, similarly, is a decrease in ownership interest due to decrease in net assets. For example, take the same example, for instance. If the software company spends $300 on the technical support to maintain the software we sold for $500, this $300 is recorded as an expense. Right? So these revenue and expenses, they are fundamental for calculating the company's profit or loss. Revenue brings money into the business. It increases net assets, while expenses represent the cost of generating that revenue. And these expenses reduce your equity or they reduce your net assets. So the difference between the total revenue and the total expenses for the period is either profit or loss. So revenue minus expenses is profit. For this to happen, your revenue must be more than expenses. But if this is not so, if your expenses are more, revenue is less, you will incur a loss. So the difference between revenue and expenses over a certain period is either a profit or a loss, and this is reflected in the financial statements as in income statement. Now we can finally combine all what we have done so far. Assets minus liabilities at the end of the period. Let's say, take some numbers to explain. We have assets worth $100,000 less liabilities $30,000 at the end of the period. So our equity is $70,000. This is one side of the equation. If you look on the other side, the starting ownership interest at the start of the period was, let's say, I'm just taking some imaginary numbers, was $50,000. He brought in some additions. He brought his personal car in the office for office use, $8,000. He withdrew a computer for the use of his son, plus business earned some revenues. Let's say business, just imaginary numbers, generated $30,000 revenue, which would increase his capital or equity, less the expenses, $15,000. So the net balance, $70,000. So the assets minus liabilities at the end of the period is equal to the opening capital or the opening owner's equity or ownership interest plus any addition made by the owner in the form of additional capital, any drawings plus revenue generated by the business less expenses should be equal to this. This should always be the case at any point in time. This equation has to be balanced. If it is not, you should not be studying accounting in the first place. Ask yourself, is this item an asset, liability, or a part of owner's interest? Cash, asset. Account receivable, asset. Inventory, asset. Property, plant and equipment, asset. Accounts payable, liability. Bank loan, liability. Mortgage payable, liability. Bonds issued, liability. Investment by the owner, ownership interest. Additional investment by the owner, ownership interest. Drawings made by the owner, deduction from ownership interest. Any revenue added to the ownership interest. Any expense or loss deducted from the ownership interest. So we need to be able to distinguish between different items, whether is it an asset or a liability or an item that affects the ownership interest. Okay, now let us discuss the rules for debit and credits. Increase in asset is debit. Decrease in asset, credit. An increase in liability, credit. A decrease in liability, debit. An increase in ownership interest is recorded as a credit. A decrease as debit. We can memorize this in a much easier way. Assets is one of the side of the accounting equation, liabilities and the ownership interest the other. This side is a debit. This side is a credit. Both must be balanced. So any increase in asset is debited, any decrease credited. Any increase in liabilities and ownership interest is credited, and any decrease is debited. So this is the quickest way to learn. Let us apply this in some examples. Let's say we purchase an equipment for cash. So what happens? Equipment is an asset increasing, so equipment debit, cash decreasing, cash credit. Equipment debit. So these two transactions are balancing themselves out. When we obtain a bank loan in the form of cash, what happens? Cash increases, debit. Liability increases, credit. Balanced. Right? Consider earning a revenue. Means you sold some goods on cash. So your cash goes up, or maybe you sold goods on credit, your account receivable goes up, which is a debit. At the same time, selling goods, whether for cash or on credit, results in income, sales, revenue. It increases. An increase in revenue, increase in ownership interest is a credit. Paying your expenses. When you pay your expenses, it decreases your cash account. So your cash or your asset decreases, it's a credit. But at the same time, you record the expense which decreases ownership interest, and it decrease in ownership interest is a debit. So always debit and credit will always be the same. Understanding these rules helps in properly recording transactions and maintaining the integrity of financial statements. So here it is summed up. Increase in asset, debit. Decrease in asset, credit. Decrease in liability, debit. Increase in liability, credit. Decrease in ownership interest, debit. Increase in ownership interest, credit. This is the fundamental concept in accounting. Learning it is very important. These rules will help you in properly recording transactions.